Is Michael Burry actually correct about this massive stock market bubble that he expects to continue to pop throughout the rest of 2022, even though we're starting to see inflation peak a little bit? You guys might have seen a lot of tweets from Michael Burry over the past year or so where he's called out this massive bubble in stocks like AMC, GameStop, and also some of the growth stocks that I personally invest in, like Nikola Motors, Plug Power, Coinbase, and so forth. And although the Nasdaq being down 30% definitely validates a lot of his arguments, we still don't know if he thinks there's more downside from these levels right now, or if he thinks the bottom is close to in. So that's exactly what I want to discuss in this video by actually breaking down one of his tweets. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So first of all, let's start off with that tweet to understand what he actually means. As you can see right now, he's essentially saying that we haven't seen this kind of environment where bonds and stocks have sold off aggressively in 4 decades. Now, I'm not sure if he's implying that this is a bullish thing or if this is a bearish thing, but for me, this is a bullish thing. And the simple reason for that is, as you can see, every single time bonds were a majority overweighted in a lot of the ETFs we trade, the market always happened to enjoy some good rallies in the future. We saw that happen in March of 2020. We also saw that happen at the end of 2008, right after the GFC bottomed. In addition, Burry is also mentioning that equity allocation versus bonds is right now in July 2022 the lowest since we've seen in April of 2009. We also saw that in May of 2020. And as you can clearly see, this is a very rare occurrence. So if you're any form of a long-term investor, whether it be bonds, stocks, or even something like crypto, you want to take note, because this is a sign that we are seeing capitulation already take place in this market, even though a lot of retail investors out there want the market to keep going down and think there's much more downside left, and that every single rally that we've seen is simply a sucker's rally. And this is a big reason why I continue to buy stocks in this kind of environment. Now, it's very difficult for us to predict whether or not the market's going to go up in the short term, but as you can see clearly, risk levels in this environment have collapsed. And as we all know, growth stocks always tend to lead the rally and the bottom. Growth stocks tend to be the first ones to sell off in an inflationary period, and they tend to be the first ones to also recover during an inflationary period. And if you guys remember, I said this 2 weeks ago, and my theory has so far proven to be correct, which is the fact that if you look at the XBI Biotech ETF, this thing has already bottomed since the middle of May, right? The S&P 500 sold off in June, and now we're starting to see the S&P 500 also start to rally over the past 1.5 weeks. And as you can see, XBI peaked in Feb of 2021, way before the S&P 500. And now that this index is rallying after a year-long bear market, for me, this is a bullish signal. And as long as this thing holds up and doesn't revisit the lows, then chances are this market is in a bottoming phase. And the difference between something like this and what we're experiencing today is, as you can see, the volume is significantly higher. And overall, a lot of the sentiment about poor earnings clearly is getting priced into the stock market. We saw Twitter and Snapchat post extremely poor earnings, but the stock market really didn't go down that much. Now, yes, we saw a pullback on Friday, but regardless, we haven't seen any sort of mass capitulation event where a lot of other stocks are down 10% on average. Instead, yes, we are still seeing a lot of fears about this recession happening and people slowing down on hiring. But the reality is that we are still expecting growth over 2021. The only thing we're expecting to see is a slowing down in that growth. And that is not something you see in a recession. So if we're really going to go into a 2008 kind of recession, we need the economic situation to be significantly worse than it is right now. If tech workers in San Francisco are staying at home, this means they have control over their wages. This means that the labor market is still hot. Now, whether or not this drives inflation, I don't know. Clearly, inflation is already starting to peak because it's mostly driven by oil. But if people like that are still having the power over their wages, then we are nowhere in this type of recession where the Dow Jones and the Nasdaq collapse another 50% from here, like we saw in 2008. As a matter of fact, in 2008, we saw a lot of nice rallies, but the reality is that it took a significantly longer amount of time for each sell-off. And the aggressive selling off we've seen in the Nasdaq so far in 2022 is actually very fast. It's a faster rate of selling than we have seen in 2008. And 2008 is obviously something where we saw the economy collapse and we saw deflation, not inflation. And deflation is something the Fed does not want to happen. And so even if we go into an economic slowdown in 2023, chances are the Fed might actually cut rates, which obviously is good for stocks. And the other thing that scared a lot of people, which is big tech cutting company forecasts and whatnot, is something the market has clearly already priced in, at least a little bit, because obviously the market's down 30%. The market is forward looking, and we now know that we are looking into the third and fourth quarter of 2022 to see how earnings for those companies will come out at that time. And we're not so much worried about what the market will do in the next month or so. And most importantly, many people tend to forget the fact that the biggest component of GDP is consumer spending. And we are not seeing any form of growth or slowdown in that, as we saw from American Express's recent earnings report, where their credit card volume actually went up. And we're expecting a similar outlook from something like Visa, which obviously accounts for over 52% of all credit card transactions all over the world. And if the consumer is staying strong, then we're not going to go into a significantly deep recession, which in my opinion, the stock market is probably not pricing in right now. And funnily enough, if you overlay the chart of the S&P 500 today from 2001 and 2008, we're roughly halfway there for a peak collapse in the market. And the reality is the situation right now from an economy standpoint is significantly better than both 2001 and 2008. So you tell me, do you want to buy into a market like this, even if in the worst case scenario, let's say we have another 20% to go down? I would much rather be a buyer, because there is no way we will know which rally is not a fake rally. There's no way we're going to predict the bottom. And for those that are sitting on the sidelines and waiting for the market to go lower, they will never end up investing in the stock market, because they will never have their peak fair moment, because they'll continue to see the market continuing to go even and even lower. But anyways, guys, that's just my take on what Michael Burry said. Let me know down in the comment section below whether or not you agree with Michael Burry and this take that we're starting to see an inflection point in inflation, and you want to be potentially taking advantage of some of the prices we're seeing in the market, even though, yes, in the short term, it is a painful environment to invest in stocks. Again, for me, I always like to be against where most of the retail investment crowd is positioned. And as of right now, I'm seeing most people bearish, and that is exactly why I continue to buy and buy and buy. But as usual, guys, make sure to drop me a thumbs up, and I'll catch you guys in the next one. Take care.